What if I told you that the world is sitting on a mountain of debt so enormous it now totals over $300 trillion? That is the combined debt of governments, companies, and households worldwide. A number so big it almost doesn't feel real.
Is this real?
That's why today we're going to unravel the real story behind global debt, how it started, who holds the bag, and what it means for your future. My name is Guy, and this is a video you can't afford to miss. Before we begin though, there's something I need to make absolutely clear. I am not a financial advisor and nothing in this video should be considered financial or investment advice. This is purely educational content meant to inform you about global debt. And if you want to get more content like this, then punch those like and subscribe buttons, smash that notification bell, and let's get into it. Now, let's start with the basics. When you hear the word debt, most people think of a credit card bill or a mortgage payment. But global debt is much bigger than just personal finance. It's the sum of every IOU, which is simply a promise to repay borrowed money. Not all debt is created equal, though. Economists split debt into three main buckets: public debt, what governments owe; corporate debt, borrowed by companies; and household debt, borrowed by families and individuals. Add it all up, and you get a number that exceeds $324 trillion as of Q1 2025. Simply mind-boggling. But of course, when people worry about a debt crisis, they're usually talking about public or government debt. That's because if a government defaults, it doesn't just hurt a few investors. It can shake the entire global system. So then, why do people borrow in the first place? Well, the short answer is that debt is a useful tool. It allows countries to spend more than they take in from taxes. Sometimes that's for emergencies like fighting wars, responding to recessions, or bailing out banks during financial crises. Other times it's to pay for big promises like pensions, social security, or new infrastructure. For companies, meanwhile, borrowing is often the only way to finance new investments or weather tough times. And for families, debt makes it possible to buy homes, pay for education, or just keep up with rising living costs. The ability to borrow has also changed substantially over time. After World War II, the global economy was rebuilt around the Bretton Woods system, which tied currencies to the US dollar, which was in turn tied to gold. This basically set a natural limit of how much money could be borrowed. But in 1971, that link was broken and the era of modern fiat currency began. This opened the floodgates for governments to borrow as much as they wanted in their own currencies, run persistent deficits, and roll over old debts instead of paying them off. Suddenly, the limit on borrowing wasn't gold in a vault, but the willingness of markets and citizens to keep buying government bonds. And we actually covered the whole Bretton Woods saga in a separate video, which you can find right over here. But debt grew for other reasons too. Every crisis leaves a scar on national balance sheets. The oil shocks of the 1970s forced governments to borrow to subsidize energy costs and keep economies afloat. The savings and loan crisis in the 1980s and the Asian financial crisis in the 1990s triggered more bailouts and more borrowing. Fast forward to 2008, the global financial crisis saw governments inject trillions to rescue banks and support demand. And then in 2020, the pandemic pushed borrowing to new heights as governments rolled out unprecedented stimulus to prevent economic collapse. So, I think you get the picture. But it's important to note, though, that debt isn't always a bad thing. Used wisely, it can fund growth, smooth out shocks, and invest in the future. Problems only start when borrowing gets out of hand, growth stalls, or interest costs pile up faster than economies can keep up. So, in 2025, we're left with a global system built on a web of IOUs. Debt connects governments, companies, and families, but it also links past decisions to the present and present risks to the future. And now let's zoom in on the main characters in this story, the countries at the top of the global debt leaderboard. Just a quick note, the debt figures here are from Q1 2025, as that was the latest confirmed data we could get. Now, the United States remained the world's single biggest borrower in Q1, with the government's gross public debt standing at about $36 trillion, or roughly 120% of GDP. For comparison, that's more than $100,000 for every American, and it is still climbing. But it wasn't just the government piling on debt. In the US, household debt, including mortgages, student loans, credit cards, and car loans, stood above $18 trillion as of early 2025, while corporate debt added another $14 trillion to the total. China, meanwhile, was another heavyweight, with government debt estimated to be at about $18 trillion, around 93% of GDP. We say estimated, though, because much of China's debt is technically on the books of local governments, state-owned enterprises, or hidden in off-balance sheet vehicles, not on the government's main balance sheet. Anyways, Japan came next, not in total dollars, but in debt to GDP ratio. Japan's government debt sat near 225% of GDP, or close to $8.8 trillion. Japan's household and corporate debts were also significant. Household debt sat at around 64% of GDP, while corporate debt was 103%. Europe too had some serious contenders. France's debt was around $3.6 trillion, or 114% of GDP. In fact, France hasn't run a balanced budget since the early 1970s. Italian debt sat just behind at $3.3 trillion, or 138% of GDP. France's household debt was about 60% of GDP, and corporate debt was around 74%. Interestingly, though, Italy's household and corporate debt levels were and remain significantly lower than France's. This is likely because Italian households and businesses have been historically much less prone to borrowing. But if you want to see a more modest example, then look at Germany, often praised for fiscal discipline. Its debt was at $2.7 trillion, or 62% of GDP. Over in the United Kingdom, debt was sitting at around $3.6 trillion, or 96% of GDP. In fact, that number had crossed the 100% threshold for the first time in modern history last year. So then, who actually holds all of this debt? Well, the answer depends on where you look. In most advanced economies, the majority of public debt is owed to domestic creditors, so think banks, pension funds, insurance companies, mutual funds, and even the central bank. For example, in Japan, the Bank of Japan owns over 50% of the government's debt. In the US, the Federal Reserve, pension funds, and households own the lion's share, close to 80%, while foreign creditors like Japan, China, and the UK own over 20% of US Treasury debt as of early 2025. Now, the 2020s have seen new buyers enter the picture, though, namely crypto stablecoin issuers. Stablecoins like USDT and USDC are pegged to the US dollar, and to maintain that peg, their issuers buy huge quantities of short-term US government debt. In fact, as of 2025, stablecoin issuers are some of the largest buyers of US Treasuries, quietly supporting the US government's ability to fund itself. For emerging and developing countries, though, it's a very different story. A much larger share of their government debt is held by foreign creditors, including private bondholders, cross-border banks, and official institutions like the IMF, World Bank, or China's state lenders. And it's not just governments that borrow from abroad either. Emerging market companies and households often rely on foreign banks and investors for loans, mortgages, and business credit, which in turn makes them very vulnerable to shifts in global interest rates and capital flows. It's worth noting, though, that the rise of global capital markets has made the who owes whom story even more complicated. Governments issue bonds that are snapped up by investors from all over the world, and international banks lend across borders on a scale never seen before.
Well, hello there. I know you're enjoying the video immensely, but I just very quickly want to tell you about the Coin Bureau deals page. Now, if you're looking for some of the very best deals and promos in all of crypto, such as, for instance, up to $100,000 in sign-up bonuses, and up to 60% in trading fee discounts on some of the top crypto exchanges out there, as well as insane discounts on hardware wallets and much more besides, then check out the Coin Bureau deals page in the description below. And now, back to the video.
Okay, next, let's break down how all this debt actually works. For countries, it starts when a government needs more money than it collects in taxes. Instead of just printing new money, which can quickly cause inflation, it borrows by selling bonds, which are essentially government promises to pay back what it borrows, plus interest. Bonds also have a set lifespan, anywhere from a few months to 30 years, and when they mature, the government is supposed to repay the amount borrowed. However, in reality, most governments almost never pay off all their debt. Instead, they issue new bonds to pay off the old ones. This process, known as rolling over the debt, means the total amount of debt often grows, or at best stays level, but rarely shrinks. There's also the invisible hand of regulation. In some countries, financial institutions are required, or at least strongly encouraged, to hold government bonds as a safe asset, which creates additional demand for government debt. This is sometimes called financial repression, a quiet way for governments to manage debt loads without explicit defaults or painful tax hikes, even if these bonds yield less than the rate of inflation. And we actually have a whole video on financial repression, which you can find right over here. And it's not just governments. Businesses and households also tap into debt markets to finance everything from new factories to buying homes or cars. Companies sell corporate bonds or take out loans, while households borrow through mortgages, student loans, and credit cards. In that sense, the mechanics of public, corporate, and household debt are all interlinked, reinforcing each other in both boom and bust. Now, the next natural question is why, after decades of economic growth and market booms, the global debt total continues to break records. Well, let's start with demographics. Across advanced economies, populations are aging rapidly. More retirees mean bigger bills for pensions, healthcare, and social support. In the United States, programs like Social Security and Medicare are projected to keep rising from about 11% of GDP in 2025 to over 14% by 2055. It's worse, though, for Japan, the world's oldest major economy. And these are costs that can't be easily cut without real political pain. Next comes infrastructure. For decades, many countries, especially in the West, have underinvested in things like roads, bridges, transit, and digital networks. As a not-so-fun fact, the American Society of Civil Engineers gave the US a C on its 2025 infrastructure report card. And that's even after Congress passed the Infrastructure Investment and Jobs Act in 2021, authorizing $1.2 trillion of investment over 5 years. China, meanwhile, is still pouring resources into new highways, power plants, and digital infrastructure to stay ahead in the global economic race. Infrastructure is expensive, though, and the benefits often show up years down the line. So governments operating from election cycle to election cycle don't often spend with a long-term vision. And then there's the new front line, the race for technological and industrial security. The US CHIPS Act and Europe's research and development drive are not just about jobs. They're about ensuring access to advanced semiconductors, batteries, and AI. China's push for technology self-reliance means massive subsidies and investments in everything from robotics to renewable energy. All these initiatives, though, add big recurring costs to public budgets, and most are being paid for with borrowed money. Then layer on shocks. Every time there's a major crisis, like a pandemic, governments ramp up spending to stabilize the economy. The result is that debt spikes in bad times, but more often than not, doesn't shrink much in good times because the commitments made often become permanent. The same goes for wars, recessions, or environmental disasters. Borrowing is the quick fix. Now, growth, or the lack of it, is an often overlooked factor here. Debt is usually measured as a percentage of GDP, so when growth stalls but borrowing continues, the ratio jumps higher. This is why some countries, even with modest new borrowing, see their debt to GDP ratios creep up every year. And even if you pay back the debt, there's also the interest. As global debt has ballooned, so have the payments required to service it, especially as central banks have raised interest rates after years of ultra-low borrowing costs. In the US, interest alone is set to climb from about 3% to over 5% of GDP by 2055, eating up a larger and larger share of federal spending. Put simply, the more you borrow, the more you pay just to stand still. But again, the story isn't limited to governments. In recent decades, households and businesses have also borrowed more than ever, often out of necessity. For families, easy access to credit, stagnant wages, and soaring costs for things like housing and education have made debt a way of life. Businesses, meanwhile, have taken advantage of low interest rates to finance everything from expansion to share buybacks. But, just like governments, when interest rates rise, they face higher refinancing costs, making debt burdens heavier for everyone, not just the state. The result is a global system where nearly every sector, governments, businesses, and households, is running harder each year just to stay in the same place. Now, at this point, you might be wondering, isn't all this debt eventually going to blow up, and is it even possible to pay it back? Well, first, as mentioned, governments almost never pay off their entire debts the way a household or business might. For countries that borrow in their own currencies, like the United States and Japan, the risk of outright default is actually pretty low. If push comes to shove, they can always print more money to make payments. But does this mean debt can just keep on rising forever? Not exactly. There's a reason economists talk about the debt to GDP ratio instead of just the raw number. As long as an economy grows as fast as, or faster than, its debt, the ratio can stabilize or even fall over time. And this is what happened in the decades after World War II. Countries borrowed massively, but rapid growth and inflation helped shrink the burden. For households and businesses, meanwhile, paying back debt depends on steady incomes, job security, and stable interest rates. When economies slow, people lose jobs, or rates spike, private debt can become a major source of risk. Defaults on mortgages, credit cards, or business loans can ripple through banks and markets, sometimes triggering broader financial instability, as seen during the global financial crisis of 2008. In that sense, the system's sustainability depends on millions of individuals and firms being able to keep up their end of the bargain, not just governments. But is there a point where debt becomes just too much? Well, economists debate this one endlessly, and there's no magic number. Instead, what matters is confidence. For governments, as long as lenders believe a country can and will meet its obligations by growing, taxing, or in practice by inflating away the debt, then borrowing can continue. But if trust falters, borrowing costs can spike and a fiscal crisis can follow. And that's why financial repression has become the go-to policy tool around the world. To recap, this essentially involves keeping interest rates below the real inflation rate to erode away the value of the debt. But this is easier said than done. Simply letting inflation run hot isn't a viable long-term option either, as it would eventually shatter public confidence in central banks and indeed the entire monetary system. The ideal scenario to deal with the debt problem would therefore be a combination of high economic growth paired with persistent but moderate inflation. But as we've all seen over the last few years, this balancing act is incredibly difficult. The recent surge in inflation forced central banks to raise interest rates, making it more expensive for governments, companies, and households to refinance their debts. And if rates stay high while growth remains weak, then debt burdens can quickly become unsustainable, even for the world's wealthiest nations. While default is rarely an option for advanced economies, in emerging markets, default is a real risk, as it is for individuals and corporations who can't keep up with their payments. So, the fact is that all this debt will likely never be paid back to zero. Instead, the world's biggest economies will do their best to keep refinancing, keep growing, and keep confidence intact. Whether that works or whether we're heading for a reset is quite literally the few $100 trillion question. But where does all of this leave us? Well, first, let's look into the future, specifically at factors that could push global debt even higher in the next decade or two. The reality is that many of the forces driving debt today are only getting stronger. The must-spend list is growing. Aging populations mean higher pension and healthcare bills. Infrastructure needs aren't going away, and now there's a new industrial and technological arms race to fund. And with global geopolitical tensions on the rise, defense budgets are growing once again too. What's more, higher interest rates and slower growth make managing debt even harder. And let's not even get into developing economies where the challenges are often multiplied. So, while some hope that faster growth powered by AI and robotics will help economies grow out of their debt, it remains just that, hope. Others argue for major tax reforms or spending restraint, but have you lately seen a politician get into government by promising to increase taxes and cut public benefits? Me neither. And the ones that tried haven't lasted long. And once again, it's not just governments feeling the squeeze. For households, rising living costs mean more debt is almost inevitable. Meanwhile, corporations are forced to pass on higher costs to their customers, leaving both hoping for lower interest rates to keep their borrowing costs manageable. But what can you do about it? Well, first, keep an eye on your real cost of living, not just the official inflation numbers. If you notice prices rising faster than your wages or investment returns, you might want to rethink how you're saving or spending. If you've taken on a mortgage or other big debts, make sure you could handle higher payments if interest rates were to jump, especially if your loan has a floating rate. It also pays to stay curious about how new technology and regulations might affect your financial life. Things like AI or changes to pension systems can sound distant or technical, but they often have real effects on what happens to your money and your future. And remember, in a high-debt world, rules can change quickly. The more nimble and informed you are, the better your chances of adapting if the ground suddenly shifts. But even though the picture looks grim, history shows that financial systems can adapt. Debt can be restructured, policies can change, and sometimes the impossible becomes possible. Let's just hope that all these AI promises come true and that we get out of this debt spiral by growth and not inflation. And if you want to know how all of this affects capitalism itself, then check out our video on it right over here. And if you haven't subscribed to the channel yet, you can do so right over here. Okay, thank you all so much for watching, and I'll see you again very soon. This is Guy, signing off.